The Fed kept rates unchanged today on June 12th. The inflation data also came in lower than expected. Markets were up dramatically on the back of these pieces of news. NASDAQ is up more than 1.9%. S&P is up more than 1%. Gold's up more than 0.5%. Bitcoin's up almost 3%. And the dollar is down almost 1.1% as well on the dollar. So we'll analyze what happened today and what's next with monetary policy in the markets with our next guest, Lobo Tiggre, editor of the Independent Speculator.com. This episode is brought to you by iTrust Capital, an IRA that offers 35 crypto assets and gold and the lowest trading fees in the crypto IRA space at 1%. If you'd like to open a new account with cash or roll over an existing account, click on the link down below to learn more and get started, or scan the QR code here. If you sign up using my link, you'll get $100 in signing bonuses. Lobo, welcome back.
Happy to be here. Happy Fed Day.
Happy Fed Day. Markets seem to be happy about the Fed and other data releases. Let's talk about what happened. So just summarize for us, please. Why are the markets reacting the way they did? And then we'll get into specifically what Jerome Powell said.
Sure. Well, the key thing to hit on first is that the euphoria, if you want to call it that, or the upturn in the markets, it was all in the morning. It was all based on CPI that gave the the broader markets confidence that higher for longer won't have to be so high for so long. Rate cuts are back on the table. Before the FOMC statement came out, there were people talking about September, a cut in September being back on the table. So we saw the markets actually substantially higher than they are now as you and I speak this morning, based on optimism on that data point in a data-dependent world. And that included gold, interestingly enough, not because gold is a risk asset that needed to rise with the NASDAQ or something like that, but because gold famously doesn't pay interest, right? So lower interest rates are typically good for gold. It's a different mechanic, similar response. And all of that was this morning. And then the FOMC comes out with their statement, and they did exactly what was expected, which was nothing. They didn't touch the rates. That was priced in, I think, quite accurately. The sort of wake-up call here is that the infamous dot plot came out, and that really flattened with by far the majority of the dots coming either with one or two rate cuts this year, and the average works out to be one. And if you look at it, it might be one or two, but mathematically it seems to work out that it calls for one rate cut by the end of this year. Now, given that we started with 6 or 7 rate cuts earlier this year, and then that dropped down to people were hoping for more, and the Fed's own dot plot said 3. So to slash that from 3 to 1 is a pretty dramatic move. And so it's interesting that the gains from this morning, they've rolled over, and the Dow is substantially lower than it was earlier today. Some of them are more sideways, and Powell's remarks seem to cheer the market a little bit, discourage it a little bit, but he didn't really drop any real bombs in his thing. The one thing that I thought really stood out, sorry to go on, but you asked like several questions, so I'm answering them all at once.
No, that's okay. It's a good summary. Please continue. Yeah.
So yeah, the thing that I thought was very interesting, or perhaps most interesting that he said, and I'm not sure the markets have fully parsed this yet, is that he said that FOMC voting members have the ability to change a dot at the last moment. And he declined to comment on how many did, but basically that means that the cut from, or the reduction in the dot plot from 3 to 1 cuts this year includes the lower than expected CPI print this morning.
I was going to ask you that because, yeah, that's a great point.
Right. That I think is really interesting. That makes the dot plot considerably more hawkish than Powell's jawboning would suggest. Now, we'll see if this sinks in, or maybe I'm missing something, but he did say that. He said they could change dots at the last moment, and he kind of, by dodging the question, implies that maybe it wasn't that many. But I've also heard Powell say before, and he didn't say this time, but I've heard him say before that at times like this, they do get data early. They can get a key information from the BLS or whatever the day before. He didn't say that this time, and I'm not sure where this is written in law anywhere, so I don't want to say that I know for a fact that it's so, but I'm quite certain that I remember him saying that before. that, it's still sequestered information. They're not allowed to talk about it, but they're allowed to see it when they make a decision. And I'm curious why that didn't come up again today. But either way, what he did admit allowed for the dot plot to reflect the much cooler than expected inflation information that we got, or misinformation, depending on your perspective. So, I'm in a way, I'm not surprised that the markets didn't just say, yay, we're back in dovish land.
It's not often that we get a Fed day the same day CPI print comes out. So today was kind of a special day in that sense. Yeah, you brought up a very good point. I wonder to what extent Jerome Powell reacted, if they did at all, to today's CPI print. Let's just go over the print. So the median expectation for the CPI for the month of May was 0.1%. It was 0%, the actual number. So no change in inflation in May, if you believe that. So CPI year over year, 3.3%. Expectation was 3.4. Core CPI was 0.2% in May. Expectation was 0.3%. So lower than expectations on all counts. I wonder if the Fed governors and or Powell reacted to this at all, or they just didn't have time because they already prepared their decision and statement and meeting notes and whatnot.
That was the implication of what Powell was saying, but he did say that they could change the dot if they wanted to, and he kind of left it like, they'd already had their views, so they didn't want to change their dots, on such a short notice. But come on, give me a break. Inflation comes in substantially cooler than you're thinking, or it's reported anyway, to be substantially cooler than expected. And you've got a model, and you know what the numbers mean to you. You probably have it on a spreadsheet somewhere where you plug the new CPI number in and it gives you a new output, which, each one of these guys and gals has their model. So to think that they didn't have time to adjust their dots because it came out the same morning, that just doesn't pass the smell test with me.
Well, let's just take a look what the market is expecting. So as of right now, around 3 p.m. Eastern time, the CME Fed Watch tool is pricing in a 58% chance of a cut by September. This is up, I would say, almost 10%, 8% since a couple of days ago. I think it's like 50% a couple of days ago. So it's
Hey,
up.
David, do you know if that's adjusted as of the FOMC meeting and Powell's press conference? Is that like live? I don't know what the frequency of updating is. Like, I would not be surprised if that was the case this morning, but for it to still be, putting in a better than 50% chance after the FOMC statement
it's pretty live because I'm updating it right now as we're speaking right now, and now it's at 56.
Well, Mr. Market is pretty optimistic. Let me throw something else in there I didn't mention in the overview of Powell's remarks and in the FOMC statement. They did increase their PCE expectation for inflation to 2.8% by the end of this year from 2.6 before. We're already under that amount, actually. So that actually is a bearish outlook from the FOMC itself. It suggests, stickier inflation than the optimists here looking for a September rate cut seem to be penciling. And remember, today's wonderful numbers, cooler than expected across the board. That was CPI, not PCE, that the Fed says is more important and that they're basing their goals on. So the same day, the Fed comes out and increases their target, their inflation expectation on their preferred measure. And to me, that doesn't square with his optimism on the CME rate forecast.
One print comes out for inflation and the market thinks we're going to get lower rates. The bond market certainly thinks that yields are down. The 10-year yield is down 1.72%. That's a lot. So the bond markets, they're pretty smart people, Lobo. They know something, and that they're usually right. So what do you think is going to happen to inflation? Do you agree with the bond markets? Inflation is going to remain either, at this level or going to continue going down?
Okay, bear in mind that I'm a due diligence guy, right?
Yeah.
I spent 15 years kicking rocks for Doug Casey, looking at mines, and that's really my specialty. I'm not an economist, though I just play one on TV sometimes. But so you're asking me,
you're very humble, Lobo. I mean, you've been pretty, you've been your forecast has been pretty good in the past for the many years that I've known you. So please give us your thoughts.
I just want to put that out there. All right. So let me before I answer, let me also remind you that we're getting to the point where base effects. Remember, we had these huge ramp ups to 9% inflation or 7% on PCE, whatever. You had this huge ramp up, and then you have the cooling numbers. It was hard to have higher inflation prints compared to those higher numbers before. So there's this giant tailwind for this year's year over year numbers based on the higher numbers from before. That's going away. In fact, we're getting to the very end of that tailwind right now. In the month ahead and going forward, that tailwind from base effects goes away or goes into reverse. So I think it's quite reasonable without making any, table pounding, clickbait headline predictions for you. I think it's very reasonable to say that the progress from here to the magical, mythical nirvana of 2% is going to be much more difficult. The base effects alone say that. And then you've got things like the OPEC Plus extending their production cuts. You've got commodities, to the degree that, I'm wrong about the recession and Dr. Copper is signaling a strong economy. You've got commodities prices up. There are a lot of reasons to think that inflation, if at the very least, will be sticky above the Fed's goal. And there's a good chance that with base effects, it'll actually start going up again over the course of this year. I don't have a goal. I don't have a number for that. I'll be pleased if I get the direction right. But we may actually be seeing a bottoming in inflation as reported by the government at any rate right now.
Well, let me posit this to you just from a consumer's perspective. I know you live in the States. A lot of big box stores are cutting prices on grocery items. You may be familiar with the headlines. Amazon, Walgreens, Target, they came in the last couple of weeks. So we're now seeing a price war between some of the biggest stores, which may or may not translate to other department stores and retailers as well, right?
Yeah, you look at these headlines, David, and in the first place, it strikes me as the lost leader strategy. None of these companies have said we are lowering all of our prices on an average of X%. None of them are like that. It's, we're lowering prices on this key item, or milk is so important, so we're going to make less profit on milk or something like that. Well, stores do this all the time. You put something on sale, you put it in the back of the store so people have to go buy all the exciting overpriced stuff on their way to the discounted item, right? And you make more money. I don't think these people are doing it on an altruistic basis here to help poor, struggling families. But to the degree that there's any truth to that, that is actually telling you that the economy is much weaker than the powers that be saying. If these companies are slashing prices because the poor consumer is struggling, how does that square with the greatest economy the United States has ever had? And I'm not just, poking fun at the current occupant of the White House. The last one said the same thing. But, these things, this doesn't square, right? These two things don't add up. You don't slash prices for struggling consumers because the labor market and the consumer is so strong and everything's wonderful.
So bottom line, you don't think that this is going to lead to a broader deflationary trend of the U.S.?
No, I don't believe that prices on average are being cut. I think we're getting headlines showing, some examples, but I don't see lower prices. I don't believe that there was
I live in Canada, so I don't know. Are you seeing anything in your everyday life things going down in price?
No, absolutely not. And
okay,
I live in Puerto Rico and it's an island, so everything has to be sent here on a ship or an airplane. Everything's more expensive here. Same product here versus in Florida or whatever. It's more expensive here. So, maybe that's difficult, but I'm not seeing lower prices when I go to the store, just the opposite.
Well, let's poll the audience. If you're watching this right now, write in the comments down below if your everyday groceries or everyday consumer goods and whatnot are going down in price or not. We're just not moving at all. All right, Lobo, I want to talk about copper and the economy. You brought up copper. What's going on? It had a huge spike and now it's kind of retraced back to its May levels. So people were really optimistic at one point that copper is, the new darling of the metal. It seems to be reversing that trend. Can you comment on that?
Yeah, well, this is another one of those. You remember all the hate that I got for when uranium was storming the mountain up to $106, and I said that a correction was likely, and I said the same thing about copper, and here we are. Look, I don't have a functioning crystal ball. I don't know the future, but when any price goes vertical like that, it is not unreasonable to be cautious about how long it can keep going vertical like that. But here's the important thing for this. And there was a moment there. In fact, one of my free weekly letters I wrote, is Dr. Copper telling me I'm wrong? Because, it's supposedly the metal with a PhD economics, right? It's such a key industrial metal that if prices are up, that's an indicator of economic activity. And I'm still in the hard landing camp. I still expect recession to become undeniable in the United States. We can come back to that if not. But the point is, that was contradicted by the market signal copper was sending. The problem is that it wasn't just like this broad-based demand or something. You didn't have oil skyrocketing at the same time. It really wasn't a broad-based economic indicator at all. There were specific copper-specific issues. You had Cobre Panama shut down, and then you had problems in Peru and Chile. You had other issues. And then there was sort of a paper trade issue with constipation, basically, on the COMEX. And there was a problem in the paper market that was temporary. I don't want to say transitory. I would get in trouble saying that, but it was worked out. And now the price is correcting again. So I think this is important, because if anybody was thinking, oh, copper is saying that the economy is fine, well, no, not so fast. The other thing that's important here is, and I think you and I have spoken about this before, silver has been tracking copper more than gold over the last year more closely. In fact, you like correlations, and I ran the correlations. It's been more than a week ago now, but recently I ran the correlations, and the correlation between silver and copper was higher than for silver and gold.
Yeah, you're absolutely right. Well, yeah, well, I'll put a chart on the screen. You're absolutely right.
They're both high, but it was above 0.9 for silver copper and below 0.9 for silver gold. Yeah. And that's a concern if you're looking, whether to invest in silver stocks or not, because if it's going to track copper, and if copper is going to go into reverse, especially if I'm right about the hard landing, that's bearish for silver. But happily, silver has been tracking gold again more. And in this recent correction, copper has really gone into reverse. Gold's gone sideways. I mean, depending on your point, and silver's been in between. So what I'm saying is silver is still acting like a monetary metal right now, and that's very encouraging. So I started this year with just gold on my shopping list, or gold stocks rather, and I've added silver because instead of its usual pattern of lagging gold and then catching up at the end, it's moved up with gold. And to the degree that I was worried about it doing that just because copper was up, well, now with copper down so much and silver holding on near the $30 level, that's what silver should be doing as a monetary metal, not an industrial metal. So I'm not so worried about copper dragging silver down, and I'm still looking to buy good silver stocks right now.
This is a few quotes from people that I've seen in the media about copper. Jeff Curry, who used to be chief economist at Goldman Sachs, now at Carlyle Group, called it the best long trade he's ever seen, citing a lot of fundamental factors like the advent of AI needing more data centers, electrification, stories that you're familiar with. Do you agree?
Absolutely. I think you and I have spoken about it before, and I've called copper a multi-decade bull market. In fact, I think you asked me once what my highest confidence commodity would be over like 10 years. And I answered copper, not gold, not uranium. It was copper, because the time frame was 10 years. The problem with the big picture thinkers like this and the big copper story, that's a great narrative. And I absolutely agree with that. The copper shortage, I think, is real. There was just a study out I saw on mining.com this morning saying, that the shortage could last until, it was CNBC, actually, of all places. It was a video story saying the copper shortage could last till 2030. I think it starts getting more serious in 2030, unless countries really in the West start rethinking their not in my backyard attitudes about big copper mines. The copper's not going to be there. But again, great. Okay, copper, multi-decade bull. That doesn't tell me that I need to brush out and buy copper stocks right now. Certainly not after a peak. Where is the bottom here? Now, I don't pretend that I can time the market and tell you exactly where the bottom is. What I can say is if you share my outlook of more prices to be paid for the Fed's tightening and other issues with the US economy and the global economy, if that recession card is on the table, then copper always corrects in a recession, always. unless this time is different, copper's going to get cheaper before it gets, goes off to the races. So that's my point. It's not I'm a copper bear. It's just, why do I want to rush out and buy copper stocks now if everything in my experience tells me that they're going to be cheaper in the months ahead?
Another point as well is that the China slowdown story has to be factored in. Traditionally, copper has been used primarily with construction. I believe it's something like, correct me if I'm wrong, but something like 50% of copper demand comes from construction globally. So if you assume that that part isn't going to pick up as well, that may put a drag long term as well on copper demand, would it not?
Yeah, and that's an important reminder. I mean, people are all excited about the impact of AI on energy prices, copper prices. Yeah, that's another one of these big ideas, right? Sure. And over the years ahead, decades ahead, yeah, I think that's a variable. It doesn't mean it's going to make copper go up now, this year. And so, the main uses, it's really quite striking. You talk about inflation reports. China just reported deflation again. Their monthly change in CPI in China out last night, as you and I speak anyway, after the U.S. markets closed, was negative 0.1. So, that's great for Chinese consumers. That stuff's getting cheaper for them. But in terms of a market indicator, in terms of global demand indicator, if China's the factory of the world, and they're seeing that negative economic indicator, that's bearish for the global economy. It's bearish for demand of commodities, and ignore that at your own peril.
Oh, well, what are we going to do about gold? Gold is just not reacting to rising equity prices the way that some safe haven advocates would expect it to. Is this just an overbought situation, or is gold kind of changing its thematic investment DNA?
Dude, I thought you were going to hit me with the Big Mac index. Where's your Big Mac?
I have to update that for you guys. But thanks for reminding me.
So, I mean, come on, give me a break. What are we going to do with gold? It's only $2,300. I mean, really? That's the complaint? It's only $2,300? Okay, but it should be $5,000.
Wait. I'm not complaining, okay? I don't know who's complaining about that.
Yeah, but no, I hear you. But this is serious. We're joking, but it's serious. Like, this is a terrific price. Excuse me, gold dollar exchange rate. The better companies are gushing cash at these levels. The mediocre companies are making good money at these levels. The crappy ones are still crappy, and that's great because now you can see who's crappy and who's not. So there's nothing wrong with gold right now. And the fact that it's done so well this year in advance of the kinds of things that I would have said, or that I did say would take it higher, like the recession or the rate cuts. We haven't had the rate cuts yet, but those are typically good for gold. And those are ahead of us from, plus or minus 2,300 base. I think that's fantastically bullish for gold. And most important is that we've seen in this latest breakout, we've seen the equities finally starting to show that leverage to the underlying metal. That's our whole reason for buying them, right? If the stocks aren't going to, they can't just move up. Gold stocks can't just move up with gold. If that's all they did, there'd be no point in buying them. It's much safer to just buy the metal. It can't go bankrupt, right? It can't be nationalized. You can't discover the legendary, endangered mosquito on your key property, right? The metal doesn't have any of those problems. So if you're not going to get leverage to the metal with the stock, there's no reason for owning them. And we haven't been seeing that leverage for last years. I'm glad you like my mosquito joke. But that leverage has come back in this latest breakout. So I think, without taking over the whole show, there's a free report on my website called Are Gold Stocks Broken? It's not really a report, it's an article, but it walks through my reasons for this. And at the time I wrote it, my assertion is they're not broken, you'll see. Now we already have that evidence. Like they're back, the mojo is back, they're doing what they're supposed to be doing. And if I'm right about where gold goes this year, if we go blow past 2,500, and I don't want to give you a number, David, because it gets a bit too Jim Cramerish if I do that, but sorry, but
you're on fire today, Lobo. I love your jokes.
If gold goes where I think it's going, and the mojo is back in the gold stocks, this is fantastic news because many of them are still on sale. if I believe there's an opportunity here, and it is my highest priority right now with my own hard-earned cash to load up on more gold stocks ahead of this.
Are the producers improving their margins? I mean, it's one thing for the gold price to go up. Are they actually managing their costs? Presumably, their costs would also go up because of inflation, right?
Yes, so that was, that's one of those things we're fortunate that I won't say it's behind us, but the worst of the inflationary blowouts was in prior years. So we're seeing it already, and we are actually getting data. I think you've seen this in Q1. All of the big gold producers beat. Now that doesn't mean they all did, great. It means they beat expectations, which is good. And for the, I don't like to tout any one company, and I'm not recommending this company. I don't own it, but the largest gold producer in the world is Newmont. And so when Newmont beat on its guidance as the largest gold company in the world, that was headline news. It was big enough to get covered on CNBC and Yahoo Finance and Bloomberg and those sorts of places that usually don't talk about gold mining stocks. But this is important for a couple of reasons. One, it's the answer to your question, is that we're seeing the companies actually have some discipline here and remember that they actually have a business. They're supposed to be making money mining, right? And they're working on that. So it's good to see the big producers beat. The other thing, though, is part of the thesis is you eventually in these markets, you're expecting a mania phase in the final stages of the blow off peak, right? For that to happen, you need to have media attention. So for the media to pay attention to Newmont quarterly earnings, like when was the last time you heard mainstream media talk about Newmont's quarterly earnings? Basically, I don't remember it ever happening in my career. Doug might remember that, or Rick, but I've never seen them do that. So this is good. This is what needs to happen in this market. Just one brief point. In the 1970s, and I did participate in the market. I was that shoeshine boy, the legendary shoeshine boy. When your shoeshine boy was talking about gold and silver, then that was an indicator of a mania. So, for me, it wasn't really shining shoes. It was lawn mowing and babysitting. But I participated in that market. And I remember everybody talking about it. That has not been present this time. It wasn't there in 2011. It certainly hasn't been something everybody's talking about this time around, even though gold's been plus or minus 2,000, 1,900 for 4 years now. That's an extraordinary period of time to have that elevated gold dollar exchange ratio. So for the media to start picking up on this, for general awareness to start kicking in here, for general asset management types to start thinking, hey, maybe I should allocate a little bit to gold now. That is a game changer. That you've talked to Rick about that. His long-term multi-decade mean of 2%. It's only 0.5%. And if people start allocating more to gold, that can quadruple investment demand. I'm not saying that's going to happen, but that shift is meaningful. And if that's what's happening now, I think it is a game changer, David.
Okay, let me throw a curveball at you because I you know me, I love doing that to you. Warren Buffett doesn't like gold. Now he's changed his mind on a lot of things. He famously said he doesn't know anything about Apple, and then lo and behold, Apple is now one of Berkshire Hathaway's largest holdings. The list goes on and on, but he hasn't changed his mind about gold. These are three things that he said about gold over the past couple of decade or so that I want to share with you. It says gold has two significant shortcomings. It has some industrial decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. That's number one. Second, it says it won't do anything except look at you. If you buy 1 ounce of gold and hold it to eternity, you're still going to have 1 ounce of gold. Number three, gold is a way of going long on fear. With an asset like gold, for example, basically gold is a way of going long on fear, and it's been pretty good way of going long on fear from time to time, but you really have to hope people become more afraid in the next year or 2 years than they are now. He said this on CNBC in 2011. Anyway, what would you say to Warren Buffett, if anything, where someone like him, I'm just using him as an example, what would you say to somebody like him to change his mind?
I don't know. I can change brother Warren's mind, but I don't know that it needs changing. So there's several actually really important issues tied into this question. One is somebody at Berkshire did buy Barrick Gold for a while. So
yes, you're right. They liked the company, but you're right. Absolutely right. They didn't like it was not because they changed their mind on gold. Yeah.
So Warren can think it's a pet rock or whatever, and that's fine. He's a businessman. He's looking for good business. So this goes back to the previous question you asked. With the gold miners now starting to gush cash, right? If that persists, Now there's a business case for any one of Warren's lieutenants to come to him and say, hey, look, here's a business that's gushing cash. And by the way, it's got a moat. Warren likes a moat. It's difficult to permit new mines. There's few businesses in the world that have better moats than miners that have the goods already in hand, because it's so difficult for competition to come in, right? So I could actually see a case where, whether it's Barrick or Newmont or one of the big players like that, I could see Warren getting back in again once we get a couple quarters showing consistent growing profits. A business proposition for Warren, not an ideological one, not a monetary metals argument, none of that fear barometer stuff. Just look, Warren, these companies are making money and the projections for the underlying commodity are upwards. I think that's enough. That should persuade somebody who isn't ideologically opposed to gold, like the MMTers or something like that. And by the way, the Barrick deal wasn't unique. Warren famously, in a previous cycle, went long silver. And that wasn't a miner, that was the metal. So under the right circumstances, even he has shown that he's willing to make a rational business decision when the ducks are all lined up for him.
Yeah, exactly. He's not an ideologue, right?
Right.
So if you were to present a business case for owning gold now, I mean, would there be one?
Next quarter, there should be. Like right now, we have one quarter of good news, but it starts to be, one data point does not a trend make. But if it continues and improves next quarter, that starts to become a good argument. And it's not just anarchists like Lobo Tiggre saying gold's going up. It's Bank of America with a $3,000 target for the end of this year. That's the sort of thing the Buffetts of the world pay attention to. But actually, I would disagree with all three of the criticisms. Gold's use, the regression theory of value takes it back to jewelry and the other things that gold is uniquely useful for. I think it's a mistake to dismiss jewelry as not an industrial use. It's still a use. And the demand is there and people like gold. But the real use of gold is as a store of value and as a medium of exchange. Gold has been money for thousands of years. And even Warren knows this. And that in itself provides demand. And you can see there's a modern experiment in this in the form of the cryptos in Bitcoin, right? The whole reason for Bitcoin or something like that to attract value is the use case of it being money-like, or perhaps if you're a Bitcoiner, it is money. That's the use case. That's the demand case, plus the limited inflation aspect, which gold also has. So that's, I think, the real underpinning. The industrial use argument is weak because the actual use of gold is as money, and that creates real demand. I mean, it's not a coincidence or a surprise that central banks around the world are hoarding gold again. So even central banks, even Basel III counts gold as a tier one asset. So that creates demand. On the second one of 1,000 years from now, all I have is still an ounce of gold. That's actually why I want it, because 1,000 years from now, whatever happens to all the colorful little pieces of paper that we call money these days, none of them are going to be left standing in 1,000 years. That's what history says. But an ounce of gold will still buy me a good suit, right? It did in Roman times. It does today. Or roughly 500 loaves of bread.
Sure.
Right? That's the argument. So his criticism is actually my reason for owning it. And I forgot what the third one was.
Third one is gold is a way of going long on fear. Let's address
yes.
that for a minute.
And that's actually a good thing. We've got two hot wars in the world right now, either of which could literally become World War III. And you've got, the stop oil now people say we're all going to be dead in 11 years.
Yeah.
I mean, just like this is the kind of world where that fear argument is in gold's favor.
I understand your point. There's a lot of hot spots to talk about, but here's my counter argument to that. So I've interviewed a lot of, gold people, as you know, and yes, everyone tries to sell some idea that there's going to be something bad precisely because of this reason. But when things actually go down the drain, people go to the dollar as well. It's the safe haven is not the only. The gold is not the only.
That's not a counter argument, David. If anything, that reminds people that gold is money, because you will see at those times gold and the dollar going up, and it happens like when Israel and Hamas, when Ukraine happened, like you'll see both gold and the dollar going up at once. And granted, usually they trade inversely, but in those safe haven moments, that really, I think, is the proof in the pudding that gold still is a safe haven. So I look, the fear argument is not the only reason to own it. If the only reason to own gold is because World War III is going to break out next week and I've got my bunker in Idaho and I'm going to need my gold stack there, if that's the only reason to go there, then I wouldn't buy. That's not very persuasive. You could have said that every day for the last 30 years if you're very fearful. But that's icing for the cake on top of everything else. I mean, the low-hanging fruit here, and we don't need to talk about gold forever, but the low-hanging fruit here, without anything crazy, even if I'm wrong about the recession, right? The low-hanging fruit is the Fed is still looking at cutting rates this year, right? This isn't some crazy anarchist theory here. This is the Fed telling you they're going to cut rates. And a rate cutting cycle is bullish for gold, even if anything else that I say is all wrong.
Final question. You mentioned that some of the miners, the bigger ones, are flush with cash right now. What do you think they're going to do with this cash, especially with 2,300, 2,400 gold? Is M&A on the table, or are they just going to stockpile cash? What do they usually do in this kind of environment?
Well, it's interesting. Barrick gave, what was it, $750 million back to shareholders in special dividends because they had a bunch of cash. And they got bupkis for this in terms of share price appreciation. Like the shareholders didn't care. And I think miners looked at that and they're like, holy cow, well, there's no point giving the money back in dividends. Let's invest. So yes, I do think we're going to see more M&A. There's been so much at the top, though, that I think it's about time to see the M&A start trickling down the ladder. You'll start seeing mid-tier consolidation, mid-tiers buying junior producers that have, a high quality asset, or even development stories where the quality of the asset looks extremely conservatively and well documented to be high. I do think we're going to see more of that. And ultimately, this is theoretical, but for people saying, "Oh, the gold stocks are broken," they're not going up with gold. If the companies are making that much cash, and shareholders just refuse to recognize that in their share price, then they will do buybacks. And ultimately, they could even take the company private. Like if the investors of the world just don't get it, refuse to buy the stock, then management can just say, screw it, we'll buy the company and take it private. And so I'm not saying that's going to happen. I'm saying that, things can't go on the way they are. If you have a great business that's flowing cash, the value of the underlying assets, whether it's NAV or NPV for the projects, is going up, right? It was a wild and crazy study a few years ago to use $2,000 gold. Now that's getting close to a conservative gold price assumption. In that world, the stocks have to move, and the managements will move them one way or the other. With the ultimate threat being to take it private if the market just won't recognize it.
Okay, very good. Well, what can we learn from the independent speculator, Lobo?
Well, that I'm not usually this wild and crazy and emotional as you've got me all riled up today.
I've done my job.
You've done your job. So the easy answer to this, I always say, is, please drop by, sign up for the free weekly newsletter. You may not agree with everything I say, but I can promise you that we will not flood you with a daily, barrage of advertisements. I hate that spam. You get one email per week. You can see how I think, see if, I could be your due diligence guy.
Great. We'll put the link down below, so make sure to follow Lobo there. Thank you very much for your time today. We'll speak again next time.
Thank you, Dave. Yeah, this was fun.
Yeah, this was. Thank you for watching. Don't forget to like and subscribe.